Hi, everybody. Good morning, and welcome to our webinar today, Optimizing Duty Savings Through Valuation. My name is Marcus Eeman, and I am a Senior Customs Manager here at Flexport. We have a wonderful webinar today, but we're going to do a few housekeeping items. First, you will see on your screen that you have a sidebar on the right side of the main stage. If you at every time during the webinar you need assistance, please message us in the help chat bar located on the side if you need to see something or have questions about how it works. Second, you can also ask questions via the Q&A on the sidebar. Time permitting, at the end of the presentation, we'll answer some audience questions. So try to get your questions in early so we can review those and try to set aside some time. But it's a little bit heavy today talking about valuation. Finally, in the menu above your screen, you have two tabs. The first tab, you can download a copy of today's slide deck. The second tab, there is a brief feedback survey for this webinar. We always love to have feedback, know what should we talk about, not talk about. So please fill that out before you exit the webinar today. We can go to the second slide for a quick legal note. Please keep in mind that all the information provided in this session is based on the situation at the current time, and that is March 6th at 10 a.m. Central, and may not be customized to your specific business requirements. We always recommend reaching out to a Flexport expert to discuss your particular situation. Joining me today are my colleagues, Anna Zajac, who's our Senior Trade Manager on the Trade Advisory team. We also have Darby Meegan, our Senior Sales Director for Omnichannel, e-commerce, and expert when it comes to warehousing and e-commerce planning. On our next slide today, we have our agenda. So we're going to go off with the latest news on tariffs. A lot of things have kind of happened this week. Some things are happening tomorrow. Something's happening on the 12th. Then we're going to go into some changes about e-commerce. Anne is going to go talk about first sale and other value considerations before we end with Darby, who's going to talk a little bit more about the physical side of the good moves and how value can play a role in that when you're considering moving your warehousing to the U.S. And then we'll have some time for Q&A at the end. So with that, let's talk about the latest news. So what happened this week? Some things went into effect. Well, the 1-month pause on Canadian and Mexican tariffs ended, and therefore tariffs went into effect. 25% on Mexican origin goods, 10 to 25% on Canadian origin goods. This is all in effect now. This is outside of USMCA. So if you are qualifying for USMCA, you're claiming that lowers your normal duty rate to 0, waives MPF. But this 25% or 10%, as it happens to be for Canadian energy, that still is in effect. So while, practically speaking, you are getting some savings from USMCA, it is no longer the free trade agreement that you maybe signed up for. They're also ineligible for drawback. Both of them are also saying that they will no longer be eligible for de minimis treatment for Mexican and Canadian origin goods. However, much like China, there's a bit of a pause in the implementation of that ban on de minimis. They're figuring out some of the components that go along with it. There's an anti-retaliatory provision that was included so far. Canada has levied new tariffs. Mexico is going to announce some next week, as the president of Mexico has said. In theory, the president could respond with retaliatory tariffs. We haven't seen that yet. Yesterday, though, we did see a notice saying that there is going to be an exemption for automotive goods from these extra 25% tariffs. Now, there was a question that was asked, does this apply to only completed cars or also auto parts? Well, at the time, the White House didn't have the answer to that. We still don't have an official word, at least not that I've seen, saying does it affect parts or not. But we do have a statement from the American Automakers Policy Council. They said we're grateful for President Trump for exempting both autos and parts and allowing USMCA to continue. So it does appear that Canadian and Mexican origin USMCA qualifying auto parts will be exempted. Haven't seen the official word on that, but that is our current understanding. When it came to China, the change here was only just the number, changing from a 10% extra tariff as pursuant to the International Emergency Economic Powers Act, went from 10% on Chinese origin goods to 20%. These are also ineligible for drawback, also ineligible for de minimis. They still have the anti-retaliatory provision that has to be, utilized. And today is the last day for that short-lived exemption you may have noticed. If something left before February 1st and arrives to the U.S. and clears before today, or before tomorrow, so on today, if it clears today and arrives today or before, then it'd be March 6th. It will be exempted from these additional IEEPA tariffs. However, this is the last day for that. So if it's not here today, you probably will not qualify. Even if it is here today, there's a couple of little nuances that may mean these tariffs still do apply. Finally, last point, there's no updates on de minimis. It is still allowed because of the implementation challenges for actually customs to restrict these de minimis imports and to try to identify these countries of origin in particular. The direction still seems clear though. Whether it's going away today, tomorrow, nobody can quite tell. So I think anybody using de minimis today should understand it is very short-lived, and very soon, very quickly, with very little notice, de minimis may go away forever. So that's what happened this week and what's happening tomorrow. But what about next week? We can look at what happens on March 12th. This is the Section 232 duties. Now, these Section 232s, these existed back in 2018, 2019. There were some administrative updates that kind of kept the original ones in place. So, but what it mainly did for those existing ones is it sunset a lot of the exclusions, the generally applicable exclusions, and even the quota provision. There was some question about, okay, well, when is a quota period? Are they still open or not? Well, our team reached out to CBP's quota desk. They replied back that it doesn't matter if the quota is unfilled for Section 232. If it hasn't, the quota hasn't been processed by the 11th of March, it doesn't matter. You're still going to have to reprocess with that 25% for either steel or aluminum. Okay, now both of these though did have an expansion. So it built on those original lists, but also included some other things. Both of these included derivatives of steel articles and expanded list of derivatives of aluminum articles, unless those steel or aluminum that went into the products were melted and poured in the United States. And there's sort of two groups here for each one. It's the ones that are in the steel chapter, chapter 73, or in the aluminum chapter, and derivative products that are outside of that chapter. The things that are in the chapter for steel, we're looking at grills, barbecues, tableware, cookware, cups, plates, screws, nuts, bolts, sinks. A lot of miscellaneous steel articles are included. Aluminum door and window frames, tableware, cookware. Anybody who likes to bake or use aluminum cast pans, you have to pay a little bit more. Aluminum ladders as well. But it's the ones outside of that there's a little bit of a delay on. What they say is that in the actual notice, when this section, these extra outside of Chapter 73 HTS codes aren't going to be effective until the Secretary of Commerce says that we now have a procedure in place to do so. And even then, it's only applying to the value of that non-US steel or aluminum product. So in the event that these do go into effect, it's not going to be on the full value, but it does get to an uncomfortable place. If you're an importer of umbrellas, for example, you now have to ask your supplier, well, wait, what's the value of the aluminum in my umbrella? And where was that aluminum melted and poured? And so because of that, that would lower your rate. You wouldn't pay it on the full $10 declared value of an umbrella, only on maybe the $7 worth of aluminum that actually composes the frame of your umbrella, not the fabric or plastic parts. So with these coming down, what can you do now? These will both be assessed at 25%. Aluminum used to be at 10, now it's at 25, effective on the 12th. You can ask your supplier about some of these things. Where was the steel or aluminum melted or poured? What's the value of it? Have that listed on your CI. It's also asking for the kilos of the aluminum and steel incorporated in those extra 73, extra 76 HTS codes. Have that listed on your CI. Start the conversation now. Don't pay any more duty than you'd otherwise have to. There's a bit of a challenge of implementation for customs. Well, how are we actually going to know this? How are we going to let importers say what was the aluminum value versus the non-aluminum value of an umbrella or a dishwasher part? How do I actually know this? Customs is working out on the how, which is why it's not going into effect right away. We would expect to see this be a little bit retroactive. Finally, if you haven't done so yet, look to right-size your customs bond. We don't know exactly how much that'll be, but when you are looking to import, try to forecast as best you can. Try to look at how much your customs bond is today. Try to get it in place for the next 12 months, just a way to kind of get ahead of some of these changes and future-proof you. Okay, well, that is our quick version to kind of say the news, but there was quite a few things that had happened this week. But you're all here to talk about customs value. And customs value to me is one of the more detailed parts of what we do here. For this, I want my colleague Anna to hop up here on stage with me. Anna, when it comes to value, I think this is really tricky because it touches on accounting and purchasing and finance and even, international tax rules. A lot of things go into customs value. So maybe you can break it down not only for me but for our audience here. How do I know what something is worth? How do I know what my value is, right? Duties are one part of it that I'm concerned about, but those duties are always assessed on the value of my goods, right? How do I know what value should I report? Tell me about customs value.
Yeah, sure. Thanks, Marcus. So, we're going to set up this conversation by just kind of talking about like what is the actual customs value. So, how is that determined for customs purpose? And 90% of transactions globally, it's transaction value, which basically means it's a sale for export to the U.S. Right? It's the actual invoice price. But there are some conditions to this, to using transaction value, which we'll get into in a minute. But there are actually 6 methods of valuation, and a lot of companies have contractual terms on their imports that preclude the use of transaction value. And so generally the rules say that you have to apply the 6 methods here in sequence, right? You can't just skip to the one that gives you the best outcome. So with that in mind, we're going to just stick with transaction value. So next slide, please. So what's really important to know about, and again, we're just setting up the terms here because you're going to hear them again in a later slide. So in order for transaction value to apply, there has to be a bona fide sale, and that sale must be for export to the U.S., right? And so what a bona fide sale actually means is, did the title transfer for the goods? Was there an exchange of consideration, meaning did you pay for them? And did the buyer assume risk of loss for the goods? So sometimes we see, especially like in an e-commerce environment, but not only that, sales can fail a bona fide sale requirement because, there's a recent customs ruling that talks about a company fulfilling their orders from Canada and using an online marketplace, and the way that these analyses are always fact specific. So the way that transaction was structured is that the end invoice price to the customer is discounted to the online marketplace, and then they pay the difference to the seller of the goods in Canada. So in that case, Customs said that the online marketplace never had any risk of loss to the goods. The title basically flashes from the seller, who bears all risk of loss, to the end customer. And in that case, they had to use the invoice price as customs value. And we'll get into why that's, why that can be a negative outcome for some companies in a later slide. Also, you want to consider the framework that you have for intercompany sales, right? So sales between third parties are generally to occur at arm's length. So there is a limitation on the use of transaction value for non-market influences. And that just basically means that if you have a lot of transactions occur between affiliate companies because of the integrated supply chains. So if that price, the way that it's determined, can't be supported under tax and customs rules separately, then it can't be, the transaction might fail for customs purposes as well. And then you're going to be stuck with one of those other methods. So it's really important. I think one thing that companies should be thinking about now today is having an interdisciplinary team together to really kind of look at these issues. Tax people get it, but they don't know the customs rules. And the customs rules really are, so for tax purposes, the transfer price between companies is usually set based on a benchmark range, looking at other companies that have similar functions and risks. It's not always easy to get a company with the same products, but the customs rules specifically state that if those benchmark companies, the profit level indicators are not the same or similar goods to the products at issue, then it's not, you can't use that transfer price for customs purposes. It may not qualify. Also, it has to be implemented at the product level, meaning that you can't just say, we're going to mark up goods 25% across the board. You have to, really review it at the product level to make sure that your benchmarking profit level indicators meet those requirements. And then finally, let's talk about the second part of that. So do we have a bona fide sale? That's a big item that a lot of many sales fail. But also, is it a sale for export to the U.S.? And we're seeing a trend for companies to store inventory off-site to defer payment of duty. The U.S. Also, the U.S. was the hub for goods shipping to Latin and North American region. We're seeing some companies, revisit those strategies in the last few years, storing goods instead in Canada or Mexico in a duty suspension program, which basically means if the goods are never imported into Canada or sold locally, you never pay the duties. But when there's a second sale, when the goods are actually shipped to the U.S., that first sale is going to fail the sale for export to the U.S. rule. And again, you're going to see why that's important in a later slide. Let's go to the next slide. So let's talk about valuation considerations, right? So what are the things that are in my toolbox to consider? So when you're looking at the valuation, you naturally want to consider whether your value is right, meaning like, are there items that can be in or out of the value that you're using to calculate the customs duties, right? So foreign inland freight paid on through BL shipment is out, but it may not be excludable if the terms are under different terms. Engineering and design work that's undertaken in the U.S. is non-dutiable, but if that engineering and design work as is common, occurs in China or somewhere else, it's going to be potentially subject to these stacking tariff measures. And like Marcus said earlier, the way that the tariffs are calculated is they're additive, right? So it's the normal trade relations rates of duties. It could be the 301, 232. They just kind of like are stacking. And now the IEEPA tariff measures, we're seeing a lot of companies pay upwards of 65% or more duty just based on the most recent actions taken. So it's really important to look at these costs, first of all, make sure that everything is in there that's supposed to be, but if there's an opportunity to unbundle or decouple those charges from the invoice price, you want to take advantage of that too. So buying and selling commission are fact-specific analysis, right? So who controls the agent? Is it the buyer or the seller? If that commission is included in the invoice price for the goods, it sort of looks like the seller has control of them because you're paying the seller for their services. And actually, in that case that I mentioned earlier, where the company, the e-commerce platform, where the value failed the bona fide sale test, in that case, Customs said that a company was acting more like a buying agent than an actual, or a selling agent than an actual buyer and seller relationship. So you can exclude pre-agreed discounts, which is a really interesting term when you set it up and you think about rebates. Rebates are in, you can't exclude them from customs value, but you can exclude pre-agreed discounts. And again, all of these elements, it's really fact specific. Don't walk away from our conversation today and say like, hey, I'm just going to start deducting them. Do your homework, make sure that the way that your transactions are structured actually meet the requirements for exclusion.
Yeah, and on that same point, Anna, I think we see quite a bit of double dipping sometimes, or at least importers maybe don't always understand. So like if they have, there's an international freight charge, maybe they're shipping on a D term kind of thing, and
Yeah,
they have an invoice that's only $8,000. Well, maybe they booked it on D terms, but the
yeah,
commercial invoice they're giving their broker is actually, an F
FOB.
terms or
Yeah,
right, X works, right? So
yeah,
actually the price that the customs broker sees, there's no more money to deduct out. So I
yeah,
think just being clear on that, making sure you're not double dipping, making sure your documents match up what's actually happening on the shipment so that
yeah.
not only your broker can understand, but the CBP auditor someday could make the same conclusion as you. That's an important one to make sure is accurate.
Yeah. I mean, yeah, that's really important in terms of whether the charges can be excluded, and even do you have documentation to support the deduction? The rules
Yeah.
require you to provide receipts, right, for these payments. So you might need an invoice copy or a check to exclude them. And so under these DDP terms, which means that the goods are delivered duty paid, that invoice price should include the freight and duty costs, but you can only deduct freight if you have a copy of the invoice. And unfortunately, a lot of companies,
Yeah.
or even like not just DD,
The actual cost, yeah, for
yeah,
I
they
think
don't
or
have,
now it's DDU, right, with the update, but it's the same challenge, right? Making sure we get those real numbers to
yeah.
take them out. Yeah, that's
Right.
true.
Or, maybe proactively, why include them to begin with? Maybe you need to go back and revisit your Incoterms because
Yep.
of the risk that you might not be able to support a deduction. It's a huge administrative burden to do that. So, yeah, definitely consider that. I think it's a great point, Marcus. So you don't want to be
Yep.
paying 65% tariffs on international freight charges because you can't prove the amount of the goods. And
Yeah.
generally, sellers are not going to give that to you under those
No.
or CIF.
Certainly a challenge, and certainly a challenge in the e-commerce environment. And we've done a couple of these the last few weeks about this, and we're getting a lot more comments. Tell me about e-commerce. What can I do?
Yeah,
I'm based in Mexico now. Like, what does this mean to me? So
yeah.
maybe talk a little bit more about that. What are some of the changes? Like, so okay, this is our nice, big, lofty understanding of
Hmm.
value. What does this actually look like, though, for maybe the e-commerce seller? What kind of options do they have now in a situation where they have de minimis, but it's on life support? It's probably going
Yeah,
away,
yeah.
literally any day now. What are some of those options available about how some of these value strategies can play in an e-commerce world?
Right. So, again, falling back on the rules, looking at like we put together some slides here on like a typical transaction flow, what we're seeing today, and which is a factory makes a good. There's a physical flow and a financial flow, and they don't always follow the same track. So, in this case, what we're seeing is companies store inventory in Canada or Mexico, and then drop them in the mail or small parcel service to the U.S. Under the current regime, if the sale is less than $800, it's not an issue because the goods are cleared under de minimis entry procedures and you never pay any duty or MPF fees. But companies the one thing you should be thinking about right now is how stable those procedures are and whether you can count on them. Like, what are you going to do tomorrow if customs just says, if Congress passes a law and says you can't use de minimis entry procedures, right? So going to the next slide, we put together that same scenario now with no de minimis exception. So what that looks like, basically, the goods ship from a factory to the offshore inventory location, and when they're sold to the customer in the U.S., you pay duty on the full value of the product, and we're using $100 unit price for our example, right? So even though the U.S. retailer might have only paid $80 for this product, this sale fails the sale for export test because it was never sent to the U.S. It's really only sold for export to the U.S. At the retail level. So in this case, if we assume a 35% rate of duty, which is really light under the current scenario, you're going to pay $35 duty, so that 35% on the full $100. And then there's a minimum MPF fee. It's called the merchandise processing fee, which is $2.62 a minimum. And then in this case, you're going to pay these fees for every single transaction. And because you're going to need a broker in the absence of de minimis procedures, there's going to be some customs processing like broker fees that would apply. So, and Marcus is going to kind of walk us through like what that looks like, the good, the bad, and the ugly. But let's just go back to go to the next slide. So under option number two, these are real conversations that we're having with companies. What if I fulfill retail sales from the factory then instead of, because I can't use my sale for export to the U.S. under the first under the prior offshore inventory scenario. So in that case, it's possible that the invoice price, that initial sale for $80, will qualify under the first sale rule because in this case, the goods are shipped directly from the factory to the U.S. And in terms of a financial flow, the factory sells the goods to the U.S. company. And if they hold title and risk for the goods until they're delivered, theoretically, you could use that earlier sale price, the $80, but you're still going to pay $28 in duty, and you're going to pay that $2.62 minimum MPF, and you're going to pay another transaction processing fee for your customs broker. And I think like the next slide really kind of brings it home. Those feeds are going to add up, and you're really going to be like no non-value added, and it's going to be difficult to pass them on to the consumer. So, option number three, if you have a bulk shipment arrangement, you could file one customs entry for 1,000 um, units, and your MPF is going to be capped at $634.62, right? So just to break that down at a unit price, because MPF is calculated at 0.3464% of the value, you're down to less than 10 cents a unit. So from a duty savings strategy, there's definitely pros to using formal entry procedures and bulk shipments. Of course, you want to consider like how you're going to finance your inventory and the customs duty costs, because under this model, the downside to this is that you're paying duty and your cash is tied up until the goods are sold, and you can recover that when the goods are sold. So with that, I guess I'm going to turn it over to Marcus to really, show us the economics of this on the macro level. What does this mean for companies, Marcus?
Yeah, and when it does come to like those bulk shipments, you really can start to see that like that hit that MPF savings, and you can do something like what they maybe call MPF consolidation, but that only kicks in at around $180,000 of value. So if you're having these smaller shipments, if you're used to kind of the e-commerce model where maybe you don't have that kind of money to bring in $180,000 and pay duty, it's harder to kind of see that benefit. But we've been hearing some back and forth. I got quite a few questions about, okay, do I do type 1? Do I do type 11? I talked about this on the last webinar I was on, but I want to make it clear the type 1 entry is much more like the type 11 entry, and the type 11 is much more like a type 1 than it is like a de minimis or a type 86. And so I just wanted to kind of like go through maybe like a hypothetical example, hopefully not too hypothetical, of a situation that I think a lot of our customers are maybe coming into today. Say there's a shipment of 500 Chinese origin dresses, you want to import. And what's the best way to maybe bring this in? Let's also assume that we're in a post de minimis environment, and you're trying to choose, okay, I've heard about this type 11. Is this actually going to save me some money here? Each dress has a customs value properly appraised at $20, for a total value of $10,000. How are you going to bring in this $10,000? How many shipments? What kind of entry type do I use? Well, there is a caveat that I want to point out here for the informal entry crowd. You may have been hearing about, oh, this is really, it's lower. There's no bond requirements, no MPF. That's all true. You still pay the duty, but the caveat that comes with this is just a lower value threshold. The overall rate is $2,500, but it does say that the limit is only $250 when it's subject to Chapter 99, Subchapter 3. Well, what is Chapter 99, Subchapter 3? Any of those special codes that start 9903. So 9903, 8803, like Section 301, 9903, 0120, like with the Chinese, or 24 now, I guess, with the Chinese IEEPA tariffs. So that really brings down that threshold and makes it look a lot less attractive. Non-Chinese origin countries, maybe your math works out a little bit different, but we also know that about 77% of e-commerce volume comes from China. So because of that, I'm going to really kind of focus toward that China model. Your math is maybe different if you source from other countries, Korea or Vietnam or India. Maybe your math looks a little bit different. I'm also assuming a standard, simple $100 entry filing fee for a regular type 1 and a very competitive rate of even a really attractive rate of $25 for a type 11. Well, overall, most of those line items are the same. You actually are going to spend more on the informal fee because you need more entries. In that middle column, you notice you only need one entry to cover this entire value. There's no value limit, at least no reasonable value limit that I think most importers need to worry about on a type 1 entry. You can just file one entry for a $100 entry fee. In total, you're going to pay about $4,800 in customs related fees. That's a combination of your administrative fees for your customs broker, in addition to everything that you're paying the government. But in the type 11 model, even at a very attractive $25 entry filing rate, you still need 40 entries to bring in $10,000 of these Chinese origin value dresses if they're under IEEPA and 301, which most of these are. That means your actual total of what you're spending to bring in this shipment of dresses, is $5,400, almost $600 more because of all these administrative fees, because that value cap is so low on subchapter 3 of 99 uh, goods, which as of February now includes anything subject to IEEPA, which is basically all of these Chinese origin products. So for a lot of importers, just moving a little bit more over to that type 11 model maybe saves you some when it comes to freight savings, maybe saves you stuff here in terms of like the broker processing fees. What is it like being a broker? Well, there's with a type 1 and a type 11, there's a certain amount of work that's the exact same across both. And it's a certain amount of set work that has to be done. You have to populate certain manifest information, header information for an entry. Takes, somewhere 5 to 25 minutes, depending on the complexity. That's kind of a sunk cost. So it doesn't matter how many lines. Usually a line is cheaper to process than having a lot more invoices or headers. And so because of that, the unit economics for customs brokers shifts more advantageously to a type 1, and that savings gets passed on to customers every day too. So I think hopefully this is a good illustration of how this can work here. But Anna, why don't you talk a little bit more about first sale? Because I know you went through that kind of quickly on, you talked about customs value, but first sale is a critical thing, right? Done right can be a very powerful savings tool. Done wrong can be a willful attempt to evade duties and hide your customs cost from CBP. So how do we walk that fine line of making sure that we are getting a correct and accurate first sale value that is defensible in front of customs and not making some sort of mistake or misinterpreting what a trading agent is maybe in a first sale setup?
Right. So under the first sale rule, basically to provide context for what it is, it basically says that if there's a chain of 2 transactions involving a middleman, if both sales were uh, made for export to the U.S., subject to certain conditions, you can use that earlier sale or lower first sale value as customs value. So obviously in the current environment, anything you can do to lower your customs value is going to be really important. Some of the challenges that we see under the first sale rule is really like that first of all, bona fide sale, right? So if you have a middleman like a trading company and you're using the title transfers immediately from the middleman to the from the factory to the middleman to the U.S. buyer, it's probably going to fail um, the bona fide sale test because the middleman never had any risk of loss for the goods. If the trading company is affiliated with the manufacturer, it's not necessarily a problem, but you need to make sure that you can prove again that a bona fide sale occurred. And that is really like a fact-based analysis, looking at agreements between the buyer and the seller on both transactions, and making sure that they can meet CBP circumstances of the sale test or an all cost plus a profit test if those companies are related. If they're not related, the transaction is assumed to occur at an arm's length. So then really you're just looking at bona fide sale and sale for export to the U.S. So going to the next slide, we talked a bit about this earlier, in an earlier example for an e-com sale, but on a larger sale, someone asked in the questions, by the way, below, about is there an additional 20% tariff on China on top of what the previous tariff was for the goods? I think this slide kind of nicely lays that out, except so the 20% tariffs on China under the issued under the International Emergency Economic Powers Act is in addition to the normal trade relations rates of duty, right? So in our case, we assume a 5% normal trade relations rate of duty. There's a 25% tariff under the Section 301 tariff measures. So in this scenario, it was 30%, but now when you add you need to add an additional 20, so the tariffs will actually be 50% of the value. So assuming a first sale value of $80, that would mean that you would owe $40 in tariffs per unit. But if your first sale, if you don't use the earlier sale, then you would be paying $50. So you can quickly see how the savings can accumulate. There is some work on the front end. We would never suggest that you just dive in and start using an earlier sale. You're going to want to make sure that you do the analysis up front, because the last thing you want to do is have an unpredictable cost structure where customs challenges you later on and then you're doing a 5-year look back. But going to the next slide, we have two slides here really to show you like who's using for sale. Companies sometimes ask us, do companies actually do this? So in 2009, when the tariffs on average were trending towards zero, the average effective duty rate was 2%. Still, 2.4% of all U.S. imports were valued under the first sale rule. And you can see here, there's no correlation between industry value or tariff rates on this slide. Um, it really comes out to like the combination of the tariff measures and the value of the imports to determine whether or not this is going to be beneficial for you to look at. And in the current environment, at a 50% or more rate of duty, companies should really be looking at all options, including maybe refreshing your transfer pricing policies, because the profit results achieved in the U.S. are going to be affected by these tariff measures. So I'm going to hand it over to my colleague to talk about considerations when we talked about, one of our scenarios was moving your warehousing to the United States. Like, what would that look like? And so I'm going to turn it over to my colleague to talk about, what the conversations that he's having with clients and, what are some of the options.
Thanks, Anna. You want to go to the next slide? We've got a list here of pros, cons, considerations of when you move warehousing to the United States from China, from Canada, from Mexico. One thing that's worth saying, as we all know in the supply chain industry, is that all of the links are inextricably linked. With that being said, there are pros and cons, and some of them are outweighing each other or in direct contention. For example, your cash flow may be impacted simply because you're holding goods at an origin location that you have not yet paid tariffs at. But then when you come to America, you're eligible for an asset-based loan at a higher valuation potentially. Other things that are considerations are, one is, what is your end game with your end consumers? Whether that's a B2B partner or retail brick and mortar, whether that's an end e-commerce consumer, which is the predominant use case of this webinar, you may see that a faster delivery to your end customer ends up reducing return rate, reducing cancellations, reducing customer support load. Additionally, you may have a pro of moving very quickly to the United States, where if more tariffs are coming or the potential for other changes, you may be able to beat them from a time scale. Additionally, you see things like the lead time to certain ports. You see the ability to use ocean freight instead of air freight, changing the cost per kilo and your landed cost of goods. These are, again, inextricably linked to the entire supply chain and worth having a discussion with your counterparts on your warehousing, your distribution, and your transportation teams. Some of the cons, again, the cash flow piece, inventory transition and moving cost. If you're currently in a warehouse with dozens, thousands, hundreds of thousands, or millions of units, there is a tangible cost of potentially moving this inventory, whether via truck, ocean, or air. The additional pieces there is often there's implementation, systematic changes needed to hook your ERP into a WMS or into your vendor's systems. And that does not come at a lack of timelines. Additionally, one of the unforeseen things is this is the labor rates in different markets. You may be seeing a bulk of your savings through tariff or through the use of Section 321 to not pay these tariffs directly. When you move to America, you may be surprised at the labor rates that these warehouses in Southern California, in the Lehigh Valley, and that they demand. On the far right, I will never be able to share as much as my customs professional colleagues have said when it comes to tariffs, when it comes to duties, but the considerations you need to make are long, and the punch card is growing. The first one that you have to ask yourself is, what do I believe is the future of Section 321, and what changes may be coming, whether through legislative action, whether through continued executive orders, or any number of actions by foreign governments and trading partners of the United States. Two, this was a question that's been asked, and I'll let my colleagues answer it, is duty drawback. As we mentioned above, there are certain duties that are not eligible for drawback when entering the United States for countries of origin. So it's worth considering that there are times and events that may be very specific to your brand, very specific to your company, that you'll want to talk to a customs and trade professional. And then I'll go very quickly is, how do I select a warehouse partner? Is standard, if an FTZ is a bonded warehouse for me. There's administrative costs, there is long lead times of setup there is procurement costs, there is management. Everything involved in that is not as simple of, I can avoid tariff payouts today by holding it in an FTZ or a bonded warehouse for a future payout date. Lastly, How does this affect my demand planning? How does this affect my procurement of parcel rates? How does this affect my insurance? How does this affect my lender? How does this affect any number of attached vendors, partners, systems, even your RMS processing? Are you able to handle these returns in an effective manner with your new provider or even bringing it in-house? This is just a quick set of the considerations. We'll move to the next slide. The final one is, what does my warehouse footprint need to look like? Do I co-locate inventory close to demand, whether that be those brick and mortar or those e-commerce customers? Do I hold it in a singular node? You can go to the next slide. Do I hold it in a singular node close to the ports of entry so that I minimize the lead time to making it sellable so that I can do these launches? Or do I do a hybrid model where I distribute some of my inventory, hold some of it in bulk for those B2B partnerships? It's all worth consideration. It's a giant math problem that reaches all the way back to how you enter goods into the United States and where your manufacturing are. With that being said, I blitzed through it because there is a long list of questions and we're approaching time and we only have a few minutes and we'd like to take some time to answer these questions. A reminder is you can still ask some questions to the right, but I will bring Anna and Marcus back up to the stage and allow them to MC it because a predominant number of these questions are customs related.
I just wanted to, one takeaway that I have from looking at your slide and even just the overall picture is I think the theme that's really important is to get an interdisciplinary team together. You need tax folks, you need finance people, demand planning. Can we service the entire U.S. from one location? And factors that companies think about is can I get to where it needs to go within 3 days or whatever that metric looks like, right, for sales inventory. So there's a lot of complexity and interwoven needs there. But I also wanted to just tie on your point about the tariffs. Some tariffs are not eligible for duty drawback. And that was asked in an earlier question. So the IEEPA tariff measures, the 25% tariffs and the Section 232 tariffs on steel and aluminum will not be eligible for duty drawback. If you import those goods through an FTZ and they're for finishing or completion, you will not be able to get out of paying those the duties on the value of the imports. But the consideration for using an FTZ, if you're still using the U.S. as a hub and spoke for the Americas region, you never pay the tariffs if you don't sell the product in the U.S., which is a big deal if you can't recover the duty back through drawback.
Yeah. I also saw there was just kind of a broader question. I think I'm going to kind of combine, a few folks, and Sarah, Charles, hope you don't mind me, and Joanna, and a couple other people trying to combine your question here, but sort of saying, okay, how do these new tariffs work? Are they stacking? Are they adjusting? What's like a total tariff here? So first of all, yes, Section 301 has been unaffected. So all those standard China tariffs that you've been paying since 2018, list 1, list 2, list 3, let me know if your eye starts twitching. All of those tariffs are still in place, unaffected so far by this. There's a handful of 301 exclusions. Most of them are gone. There's no real plan to do new ones. So any of those are still there. So that 25% for most is still in place. They're not being replaced. That's in addition to. So this additional 20% off or 20% tariff, we're going from 10% to now 20. So it's not a 20% increase on 10. It's changing from 10 to 20. So you say I have $100 worth of import and now pay $20 if it's Chinese origin, no longer $10. This is a change to those most recently announced tariffs back in February, the IEEPA tariffs. And somebody asked kind of a math question here. Well, okay, hold on. If I have 301 and 232 and these IEEPA, how much am I paying? Well, let me bring it together here. I actually have my water bottle. It's not vacuum insulated of 9617. It's a vacuum, or it's a regular water bottle of 7323, 7324, one of those, the household tariff ones, right? So I'm going to pay on this, if it's Chinese origin, I'm going to pay 25% as of March 12 for the Section 232 if my steel wasn't made in the US. I'm going to pay 25% by virtue of list 3 for Section 301. And I'm going to pay an additional 20% for the IEEPA tariffs. So altogether, and in addition to the 2.6% normal duty. So altogether, I'm going to pay about 72.6% for importing one water bottle like this on the value. So I better hope I have my customs value right when I'm declaring this. Otherwise, it's going to get really expensive. So on that note for valuation, I know we just hit time, Anna, but I got to give a bone to somebody who asked a really great question on value. Bob asked, how's the value determined in a subsidiary sale? That is, where an Asian company sells to their U.S. subsidiary, who then sells to a U.S. customer, the end user.
Right.
How does the value work in that scenario?
Right. So, depending, so if the sale is to the U.S. company, a lot of companies like entrepreneurial that own foreign IP will set up a U.S. sales office for purposes of developing a market in the U.S. So, as long as that price is based on an intercompany price, a formula that's objective and complies with all of the tax and customs rules, it can be used. So one thing for companies to think about, though, is that the tax rules and customs rules work inversely, meaning a higher value for customs purposes will result in more duty, but lower income achieved in the U.S. and lower income taxes, right? So there was a time when tariffs were trending towards zero, where companies didn't mind overpaying their goods. But now when you look at the overall picture, you might not hit those benchmark profit level indicators because of the tariffs if you're not able to pass them on to customers. So companies really need to think about that. And whether they have document in place to claim those adjustments, right? So if you have to bring your price down and try to recover duties, if you don't have that objective formula documented, and if all the framework can't be, proved up, then you're going to be in a tough spot, and you're going to be stuck holding the bag with the customs duties. We have one question that I wanted to answer. This is my favorite question. Someone asked, like, I saw something in the news yesterday about the automotive parts. Like, when is it real? We tell clients every day, it's not real until it's published in the Federal Register. You cannot legislate from Twitter or Truth Social. So check the Federal Register every day. Check the White House. There's a difference between a press release and a presidential proclamation and an executive order, right? Like, official actions taken are executive orders, proclamations that are ultimately, everything goes into the Federal Register, and that's when it becomes rule. So some of them are published with a forward-looking date, like you see with the aluminum and steel tariffs on March 12th. Some of them, it's possible that something could be implemented retroactively depending on the situation. So
yeah.
check
And,
that.
I actually had a chance to talk with a couple of customs folks informally, some pretty senior folks at customs, and they had said that they didn't know about these IEEPA tariffs until they saw it on Truth Social. So the people that are actually in charge of implementing this and collecting duties are finding out right about the same time we are. At least that's how it was back in February. Maybe they get a little bit more lead time now, but I think they're really going for speed here, really going for how quickly can we get these announcements in place. But, Anna, you're exactly right. Federal Register is official. Presidential proclamations are official. Other than that, it's rumor. So if you're not getting your source from that, give it the appropriate counterweight in terms of validity. So,
And watch for changes, because as we've seen, like
and
these
watch for
measures
changes.
can be peeled back just as quickly as they were implemented. So
Yeah. Yep. Well, let's see. I don't know, Carol, do we have time for another one, or should we wrap it up here? I know we're over.
I have one question,
Oh,
Marcus or Anna, that I'd see from Juan, which is, I'm an exporter from Mexico selling into the US via DDP. If I want the customer to bear these tariff increases, can I increase the price or pass through the tariff clearly without increasing the value of the goods so that the tariff remains at the original price instead of a marked up price for the tariff?
right. So just
yeah.
remember that the cost of goods, duty is not subject to duty, right? You don't pay duty on international freight or duty, but you need to make sure that it's clear, right? You should list those charges separately itemize them on a DDP invoice, so that it's very clear what the actual costs of those items are that are included in the invoice price.
Yeah, as like a general rule, it doesn't matter what Incoterm in general, it doesn't matter what Incoterms you ship on. Your declared value won't really change. You may have to do some work to back out some charges, right? Got to take out the freight charges, have to take out the duty charges, have to take out something else, right? But in theory, in a vacuum, whether you ship X Works or DDU, either way, anything in between, your value of the goods probably won't be changing too much. Now, I'm sure there's an edge case somebody's going to email me about, and I'm sure they're right. But in general, you should take that as like a consideration. So if you did have to increase your invoice price, what the person's going to pay back to you because you're shipping a DDP, you may have to do so, but that shouldn't necessarily affect the customs value that you use for duty calculation. So if you want to, you're selling DDP and you're going to bake that cost in, that extra 25% for Mexican origin products, you can bake that into your invoice, and your customer will have to pay that invoice, but you're still allowed to take out some of those charges when you actually, submit a DDP invoice or DDU invoice for customs valuation for when you actually make your entry.
There's one more question just about like value. What's the burden of proof when declaring cost of goods sold against production volumes? I think what they're saying is that companies use like an average costing method for their transfer price. And that's exactly why sometimes transfer pricing policies call for a profit, an adjustment process. So that needs to be defined in the transfer pricing policy. If you want to go back and adjust your price after the fact, companies use programs like reconciliation to do that. But if it's not, there have been rulings on this where the intercompany policy is not definitive. It says we may charge you, not that we will. And that sort of language can be weakening for your position on claiming deductions because it's not a fixed price or objective because the seller clearly has control over it. And you don't need a lawyer to do first sale rule, but you should hire a professional to review your fact set. We work with a lot of clients, and generally what we'll do is we'll do a fit gap analysis. Show me your documentation, your transfer pricing policies, your invoices, purchase orders. I want to see your distribution agreement. And let's talk about the terms in there. And generally, it's not like a thumbs up, thumbs down. If we find gaps, we'll make recommendations like, hey, you should consider changing your Incoterms because this is not going to be bona fide sale, for example. So all of those are things that you can, work through if you look at it proactively.
Yep.
Happy to help with
All
that.
right. Well, with that, I think we'll have to wrap it up here today, Anna. Let's just do a quick plug. Our email address, if you wanted to talk about de minimis, e-commerce, 321 customs matters, that's going to be 321customs@flexport.com. That'll get over to me here. Anna, is it advisory@flexport.com? Is that the email that our listeners today should be reaching out to you with? Okay, so advisory@flexport.com. And Darby, what's the best email if they wanted to talk to you to find out about warehousing needs? What email address should they use for that?
Meegan, DMEEGAN @flexport.com. Happy to talk.
Well, that's great. Okay, so that concludes today's webinar. We have another one that's going to be much more focused on the tariff stuff. So if you like what I did in the news segment, we're going to be doing more of that here on the 18th after these 232s go into effect. And who knows what future agreements come out in the next 2 weeks. We'll have to sort that out. Please click the link in the chat to save your spot in that webinar. Please fill out the feedback as well in the survey. We do look at those surveys. We do want to see how can we tweak our webinars, make them more helpful. How can we talk more about what you want to listen to? So with that, we'll have an email for a link with the link to the recording for everybody. Thanks, everybody. Have a great rest of your day. Thanks for listening.